Annual taxes. Real estate investors should know what taxes they have to pay and which deductions they're eligible for so they can plan for the future. First is income tax. These taxes that everyone must pay take into account all kinds of personal income for Canadians. For real estate investor, this includes the profits from renting out or selling properties. Landlords in particular must fill out a specific tax form called the Statement of Real Estate Rentals, Form T776, which lists all rental income and losses for the year. Income taxes are paid to the Canada Revenue Agency, also known as CRA. Rental income is taxed at different rates, depending on the ownership of the rental property. A sole proprietorship means that the unit is owned by one person who pays full tax on all their income, including rental income, based on their marginal tax bracket. A partnership means that the unit is owned by two or more people who split the rental income and potentially avoid a higher personal tax rate. A corporation is the third form of ownership. The tax rate for a corporation is different from that of individuals or partnerships, as corporations pay federal and provincial taxes. Depending on your overall income, you can save on taxes by remaining as a sole proprietor, co-owning in a partnership, or by incorporating. You can also reduce the income taxes you need to pay by leveraging deductions. This requires an understanding of relevant expenses. These refer to the costs related to the building, acquiring and keeping a property that you can report alongside your profits and losses. Common expenses include maintenance fees, insurance payments, management fees, mortgage interest only, and monthly utilities. Expenses can also be divided into two types. The first is called a current expense. This is often a recurring charge needed to help keep a property in good condition. For example, repainting the outside of a building is considered a current expense. The second type is called a capital expense. This improves a property beyond its original condition, adding long-term benefits and greater real estate value. So instead of painting the building exterior, someone could upgrade the materials from wood to brick, for example. Owning a property that depreciates can impact your taxes. It is recommended that you speak to an accounting expert in order to maximize your tax deductions. The second important tax you must pay when owning real estate is property tax. While income taxes are paid to the federal government, property taxes are paid to the municipal government. These taxes go towards things like local infrastructure, community services, and education. Each city or town sets its own tax rate, but you will find out that some of the larger municipalities with higher than average property values have the lowest tax rates. In fact, the 6 cities and towns with the lowest tax rates in 2022 had rates lower than 0.75%. These cities were Toronto, Vaughan, Richmond Hill, Markham, Oakville, and Milton. Property taxes are calculated based on property's assessed value, which the Municipal Property Assessment Corporation, also known as MPAC, determines. There is no way to lower your annual property taxes like you can with income tax deductions. However, the MPAC makes its assessments once every 4 years, and the property value is usually set below market value, so property owners automatically pay less tax. Now that you're familiar with income and property taxes, you're better prepared for your financial journey in real estate investing. At GTA Homes, we aim to help our clients build towards a brighter financial future with real estate investments. This includes providing information about taxes, fees, and closing costs so that you're well prepared to achieve financial success. Remember to subscribe and to visit us at gtahomes.com.